Good evening. On behalf of the Tech and ESG committees of the CFA Society France, welcome to the first panel of the Tech and ESG event series, ESG Data. Tonight is the first opus of this series where we will talk about challenges surrounding ESG data and options and hopes that techs bring us on that topic. While during the second one event, scheduled in January, we will deal with models and scoring challenges. My name is Gabriel Huet. I've been involved in financial markets for more than 20 years, and I currently work for Natixis as a credit trader. I have been leading the ESG committee for 2 years now. I'm glad to introduce you those who have organized this event, Kim Mantel and Lenny Kessler. Kim was chair of the Tech committee for the past year and continues to lead the events project. She is product manager at Evenize, a software compares dedicated to providing solutions to asset managers. Previously, she worked for 7 years as a management consultant, predominantly at Accenture in the financial industry. Lenny is an active member of the ESG committee. He is focused on ESG and reporting and has co-founded YO to bring solutions on these topics to professional investors. First of all, a few words to remind you what are our committees and why this event tonight. The Tech and ESG committees are committed to supporting CFA Society France members on topics related to new technologies and ESG issues. The committees support members on training and skill issues, organize knowledge sharing, are a meeting place for members to establish and maintain a network on their area of expertise, represent the voice of the French community in public consultation on ESG or tech issues. So why this event? The theme of the ESG data is perhaps the most important and constraining when it comes to sustainable development. Important because the data is part of the definitions of an extra financial risk factor and contributes to the qualification of its materiality. Binding because without continuous good quality data, investment decisions are made on an erroneous basis, and as a result, the risks are misplaced. In addition, data has become a key issue since the various regulations, particularly European ones and FRD taxonomy, set availability, the consistency and homogeneity of the data a legal requirement and oblige the financial industry to implement sufficient controls. This theme is therefore central and is common to both our ESG and tech worlds. While data is the main challenge facing the financial industry, it is also a formidable source of opportunity for fintech companies developing new technologies to provide solutions and open up new horizons. We therefore wanted to organize this series in order to provide an overview of the challenges and opportunities and to meet key players at the heart of this reality. During this first panel, we will address the raw data, its definition, its role, and its various fields of application. To present the business challenges since in asset management, we welcome Etienne Vincent from OSIAM. And to get a fintech perspective, we welcome Grégoire Hugues, WeFin, and Alex Monet from Oxeo, who will share the assessment of the current situation and their vision of the evolution of the challenges and opportunities. Each panelist will defend their point of view and then answer any question you may have during a Q&A session. Lenny, the mic is yours.
Thank you, Gabriel. So we will start with Etienne. Maybe you can present yourself in a couple minutes and then go right into the subject and give us what are the main challenges with ESG data from your point of view as an asset manager.
Thank you. Well, my name is Etienne Vincent. I've been working in quant asset management for more than 10 years. Well, for a long time at BNP and now at OSIAM, the affiliate of the Natixis group. So, well, I'm in charge now of marketing and, well, contributing to defining a strategy on the strategies we run at OSIAM, and we've been very active with ESG for quite some time. So now to deep dive in the subject directly, well, troubles with data are not, well, new. Even before there was ESG, we already had some trouble with data because data can have noise, they can have systematic biases, and those kind of troubles, we also get them with ESG. Then we'll see we also have some specific issues with ESG data. But to come back to those very generic sources of errors, well, the first question is about systematic biases. For instance, we see very quickly that when you look at ESG data, well, between countries, you've got very different results, just because some countries give more importance to ESG than others. So if you look at the blunt scores, very typically you'll get a distribution of countries that is not the same as the original universe. The same goes also for sectors. Most notably, if you take into account measures that relate to pollution, because some sectors are obviously natural polluters. And therefore, if you just look at the blunt pollution score, well, you might want to exclude them completely. Whereas if you look at it on a relative basis, it will give a completely different picture, where, for instance, an energy producer that is a slightly less producer of carbon will be rated better within the energy producers. But then there are still some other biases. For instance, we usually notice with ESG ratings that the bigger a company, usually the better it scores. One of the reasons can be that they have bigger teams, or it can be that they are more conscious of global subjects. So for all those biases, the question is, do you want to remove them or do you not want to remove them? But if you don't, then it will create natural differences in your strategies compared to the original universe or benchmark. Most notably, of course, this year, it's quite important. We've seen, for instance, lots of papers talk about the overperformance of ESG this year, but it's to a large extent related to the underperformance of oil. And therefore, the question is always, are you talking about the ESG or about the oil price? And that is actually one of the difficult questions about all the discussions around the materiality of performance and the use of typically past data to prove the overperformance of a given approach. But for all that, we still have, from the quantitative perspective, a way of removing those biases, which is normalization. But as I said just before, you might want to normalize, or on the contrary, you might refuse to normalize because the effects are still true. And then we also have new issues with ESG data. While some of them come from the fact that many of those data are actually declarative. It's the existence of a rule or of a procedure. And of course, this changes, well, according to how the people who answer want to be honest or not, or even if they are honest, well, according, for instance, to the fact that they speak English or not. Just to give an example, in Japan, well, you have typically two types of companies, the ones that work only in Japan and the ones which work with the outside world. And those second type will have documents in English, will usually answer questionnaires, and they will get much better ESG ratings, well, just because you do have the data. And that's, of course, a problem, because it doesn't mean that if you don't speak English, you're actually worse at ESG. So these kind of issues that come from the fact that many data are declarative, of course, are an issue. And of course, explain why there is a big push towards other types of data, trying to measure actual things. And typically on the quant side, which is typically our case, we try to go to data that don't depend on a declaration, but that actually can be measured outside. So for instance, well, carbon emissions can be of that type, they can be measured, they can be checked. And of course, the whole subject of ESG risk, which is also external and based on impact, is trying to get away from some of those specific trouble of ESG data. So, well, that's not everything there is to say about, well, biases in general and biases in ESG. But maybe just before switching to another question, if I still have 1 minute, just to highlight that ESG is a relatively new subject. In terms of length of data, we usually don't have what quants would consider to be actually significant. What is even worse is that the subject has been rising recently. And that's why also it's another source of trouble, which is that you might be looking at the data today that sounds like it's the same data like 5 years ago, except that 5 years ago it was kind of overlooked, non-important data, whereas now it's actually a very important data. So the simple fact that the importance of the data has changed can be a source of changes in the result. And for instance, if you take raw ESG scores of many companies through time, well, you see them improve quite a lot through time. So of course, once again, it's a question of neutralization. Do you want to neutralize time or not? And that's one of the challenges that probably we'll have some occasion to discuss further.
Thank you. And this brings me another question, and also because we had a chat before to prepare this. When you talk about countries and materiality, you mentioned the influence of social norms and evolving social norms on ESG data. Can you elaborate a bit?
Yes, it's an evolution both well, through time and also geographically. For instance, in Europe, well, we are all aware of this big discussion, typically between the Germans and the French, about nuclear power, about whether nuclear is bad or good. So, of course, the point of view of the French is that it's rather good because it enables to, well, produce less carbon in the short term, but of course, over the long term, it has some issues. And there you see that the point of view can be very different geographically. The same goes for other subjects, and one typical of that is governance. You might have, for instance, a very liberal view on governance that can be in some ratings or some views that tries to say, basically, if I put it bluntly, that, well, all companies should be run like American companies. But then you can have more local visions of what governance should be, and it can be significantly different. So that's geographically, but also through time. Typically, we've seen a strong evolution where a few years ago, governance was an important subject within ESG, whereas recently, all that is related to climate change and climate risk has well, taken a much more important part in well, perception in general and in weightings of ESG scores in particular, with, of course, all the questions that, well, it doesn't mean at all the same thing to try to save the planet when you are an industrial company using actually a lot of resources, and when you're, for instance, bank, where the environmental rating might be of lesser importance. So that's all the subject about the weighting of the different aspects and the different issues within ESG and their evolution, which also to some extent depends on the philosophy you have at first in the reasons why you want to do ESG.
Thank you very much, Etienne. So we understand data is a jungle with a lot of parameters to take into account. Maybe Grégoire Hugues can help us understand a bit better how an asset manager can actually choose the right data in this. But before, if you can introduce yourself in a couple minutes. Thank you.
Yes, thank you, Lenny, and thank you, the CFA Society, for the invitation. I'm Grégoire Hug. I'm one of the co-founder of Wifin. And Wifin is a young fintech. We are working in the sustainable finance field. And we do believe that it's important to spread sustainable finance data inside asset managers and asset owner strategies. And we want to use technology to foster that. So that's why in Wifin, we've developed two products. One is an aggregation product for ESG datasets called ESG Connect, and the other, which is in line with your question, is called ESG Access. And it's our product to help asset managers picking the right ESG datasets. And we came up with this idea because definitively we thought that the ESG data provider market is kind of a jungle, indeed. So we've made an overview of that market and found out that there were actually today more than 75 data providers. So that means that the market is very huge, it's growing very quickly, and one asset managers will not have the time to scan all the markets. You probably all are discovering today that there are as many data providers as that. So we came up with a process to screen all these data providers, to come up with short list and understand better how they are working. So basically, what we prefer is to focus on 5 dimensions. First, asset managers need to look at ESG data sets that are in line with their investment strategies. That's something that is obvious, but that is very important. For example, if you run a quant strategy, for example, so you'll need historical data sets with multiple years of history. And of course, you will need something that is refreshed frequently. You can't afford to use a data set that will be refreshed each year or every 2 years, which is sometimes the case. So tech providers that are using technology to gather ESG data sources, that are using NLP, for example, maybe we'll discuss that later, to gather data source, are usually useful for quant strategies because they can refresh the data more frequently than classic data providers. But of course, the equations will be completely different if you run a fundamental analysis, and then you will need more qualitative information. The second point to be looked at is the data type. So I think before, at the beginning of ESG and before its rise that quickly, what you had were generalist mainstream providers. So providers like MSCI or Sustainalytics will have all the data you need. All thematics were covered by these data providers. So either it would be waste or biodiversity or gender equality. You will all gather all your data in one place. But as of today, you have many specialists that have better data sets on specific thematics. So, for example, local employment is a thematic that is run by one specific data provider in France called Impact. You have, of course, specialists on climate and environment. And so asset managers now need to look at several data sources and aggregate all data sources inside their investment strategy. So that is good in a sense that they have more diversity, but that is raising more challenging regarding the harmonization of data and the normalization of all these data sets. The coverage then is maybe one of the biggest issues. If you look at data sets, providers will come up with offers with hundreds of data points, which is fine. People will tell you, okay, I have 300 data points for your investment strategies. But when you look at the data closely, the coverage is not the same for each data point. So when you are selecting a data provider, you really need to look at the coverage field by field, which is very time consuming, but which is definitely important because at the end of the day, you end up with data sets with maybe more than 50% of the data set where your coverage is less than 30% or something like that, which is completely impossible to use when you want to run your strategy. Then the quality is important. And I think here we need to have a bigger focus on the methodology. Indeed, as Etienne said it before, the data sets are unstable, and sometimes a carbon footprint that is disclosed by a specific data provider is not the same as the one as another data provider. That's very easy to understand because even if data providers will all start with the CDP, the Carbon Disclosure Project dataset, which is the datasets used by everyone, they will all have their internal methodology, their own view on what is a carbon footprint. They will check that data, compare it, and challenge what is reported by company. And definitively, this will change the end results. And maybe the last dimension to look at would be the price, and not only to have a price that is as low as possible, which is fine, I understand that, but to understand how the data can be used. Because if we discussed ESG today, it's not only for the investment strategy itself, but it's as well to bring more transparency to the end investor, to bring in more information so that he understands what is done on the asset management side. And so you will need to report your data sets. And so that's important to check that with the data provider to understand if it generates an additional cost or not. So I would say that this would be the 5 dimensions to scan and to come up with a short list as quickly as possible to avoid this ESG data provider jungle.
Thank you, Grégoire. And actually, your last point on reporting and transparency brings another question, since this is mainly driven by regulatory changes and evolutions. How much of the demand in data do you see is driven by this regulatory movement, and how much comes from other motives?
I think 50% of the demand is coming from regulation, approximately. Roughly, in that case, our clients will have a comply approach. And it's a very difficult time for them, given that we all know that regulation is coming. That's fine. We all know that regulation is in the coming month or year, but it's still unclear what will be asked. So if we looked at disclosure, for example, the future European regulation on sustainability that will force asset managers to disclose sustainability metrics, we all know that there will be a disclosure to be made, but not yet which KPI will have to be disclosed. So we are a bit lost in transition, if we can say it like that. And like projects are all stuck because people are waiting for the regulators to give more details. And I think it's a very challenging moment for them. So the more interesting part are the other 50% that are more coming for client pressures. So I'm seeing more and more asset owners who are demanding more information regarding the sustainability strategies of asset managers. So before, you could have an ESG score and register to the PRI and say, okay, I'm done with my ESG strategy. That's fine. And now what I'm seeing is that asset owners will ask for the consistency of the strategy and will ask for resources internally that can speak about ESG and that can have an expertise, and they will value an internal ESG model, which is maybe an evolution that is very important, meaning that now asset managers will probably use data providers more to gather granular information, and they will then have their own scoring methodology. This will help them to avoid a black box effect and to speak more openly about sustainability with their clients. So I believe this is a major evolution to avoid the black box scoring of ESG data provider and to calculate more indicators internally. So I think it's an interesting evolution, and that will be in line with what the regulation is asking, because regulation will ask, regulators are asking more and more asset managers to disclose specific KPIs and to open the box.
Thank you, Grégoire. And I think this is indeed a great, interesting question. Maybe we'll have more in the Q&A on how much has to be done internally. But just in the interest of time, let's give the word to Alex. If you could present yourself. I know you have a very different approach to data, very bottom up. So the floor is yours.
Thank you, Lenny, and thanks very much to CFA France for this opportunity. I have to say, it's great to follow two speakers like Etienne and Grégoire, because I think there's a lot of landscaping that they've done. I mean, just briefly, sorry, my name is Alex Money. In terms of my background, I come to this with about 25 years of experience. The first 10 as a professional investor, a fund manager, and then in capital markets advisory, and then most recently in academia. Look, I think there are three things that I mean, there are three problems that interest me and the company that I've set up called Oxford Earth Observation. And those three things are, firstly, this disconnect between a lot of us who understand that ESG is salient to valuation. It's a material factor in understanding long-term company valuation on the one side, and on the other side, having still very poor quality tools that are decision ready in driving investment decisions around ESG factors. So there's disconnect between knowing stuff is important and not being able to have access to decision ready data. One. The second is a point that Etienne surfaced first of all, and Grégoire also touched on it, is that existing data sets are quite heavily reliant on disclosure, on historic disclosure, with all the biases and challenges that has been talked about it. They're also quite backward looking. So we're trying to make forward assessments of risks based on looking backwards, which has their own challenges. And they're often the data that you're looking at isn't at the appropriate level of granularity for the risk that you're trying to understand. It's either too generic or not company specific, or in some other way quite intractable. So these are the three challenges around that we're concerned about. And then the final thing is, and this is talking about climate risk, which I think again, Etienne was saying, has sort of become flavor of the month in recent weeks. We take some issue with this model. There's a traditional hazard exposure vulnerability model that is used in climate modeling, right? Which tries to work top down and cascade analysis into decisions, which in my experience and talking to people who try to, talk to people who invest money, is quite challenging to use. So we take those three problems and we look at it a bit differently. We look at the solution in terms of three buckets. And so bucket one is understanding environmental variables objectively and comparably. And so we use Earth observation, we use satellite imagery to detect changes in observable variables such as water and water extent and water quality, using around 40 years of historical data sets that are now available, for example, via Landsat or Sentinel here in Europe. So the first block is change detection, to develop baselines to understand how environmental variables may change over time. The second block is saying, well, if you can see what's happened in the past, how do you project what happens in the future? Because that's what we're interested in. And here we use a range of models, including the sort of best available climate science models, but also models on land use, on population, on settlement growth, and so on, to project to what extent historical trends may be different in the future. So we do some regression work, but we also look at what is changing, what parameters look different going forward that might mean that you would change your projections of risk going out 10, 20, 30 years, using different scenarios, different conditions, different levels of uncertainty. And the third part that we do is what we call the so what part, right? Which is, it's fine to understand what the variables are and how they're going to change, but unless you can understand them at the scale of the asset they're affecting, then it's very, very hard to make decisions. And so by the asset, in a global mining company, you're thinking about individual mines. In the case of an apparel company, you might be thinking about the textile factories, the garments, food and beverage company, the farms, the factories. So at that level of scale. So we have these three buckets: Earth observation, modeling, and asset level data. And in each of those areas, we do proprietary work, which we can maybe come back onto. I just wanted to make the case of what we look at. The environmental variable that we have focused our work on over the last couple of years is water risk. I mean, there are some specific historical reasons. My own background and my PhD is in that area, but also because water is this really super interesting risk that has both physical aspects of climate risk and transition aspects of climate risk, as we think about this in this sort of TCFD framework. So the physical aspects, of course, we're all familiar with in terms of scarcity and so on. But water has so many issues around license to operate, around governance, around societal aspects. I saw a question come up in the Zoom box about the societal elements of ESG. And so understanding how water risk can be understood and projected and reflected at the specific asset level, I think is really important to understanding, making information decision ready for investors. Let me pause there, Lenny. I think you might be on mute, Lenny.
Sorry. Thank you, Alex. That's very interesting. I understood in our previous conversation that you also look at correlation that we're not usually familiar with. Again, because you have this capacity to go down at the asset level. Can you give us an example and explain a bit more how it works?
Yeah, I mean, absolutely. So we're quite interested in how understanding asset level data, and so data that you may not normally look at in the course of your evaluation process. So environmental or ESG data at the asset level may drive you to make different decisions about your portfolio, the stocks you hold, and the combination of stocks you hold because of further information. So to give you like a concrete example here, you might take two different sectors that you hold in your portfolio. So you may hold something cyclical, right? Something that like mining stocks, which you would hold because you'd be playing an economic upcycle, for example, on one side, and then you might be holding something defensive, like a food or a beverage stock that you would also hold in the portfolio, because generally speaking, even in downturns, food and bev stocks tend to outperform because people still eat and drink, for example. And so in a balanced portfolio where you're trying to balance risk up, holding those stocks together may make a lot of sense in terms of a risk diversification mitigation strategy. And if you look at conventional correlations, there would be a good argument to use that on a sort of optimization or whatever else. But the interesting thing is, if you think about these companies fundamentally, and take these two examples of mining and food, both companies in both those sectors are really water dependent. So mining companies use water upstream in the production process, for example, and downstream in processing the ore, on how they return the water back to the water course. All of those things the water is important. And of course, for food and beverage companies, water is fundamentally important there too. And so when we began to look at asset level data, we began unpacking. So we have a proprietary data set that we look at where individual assets are located. And then we have been examining river basins and individual water bodies in highly stressed river basins. And here's the interesting thing. We often find that in a stressed river basin, individual body which just stressed, there will be assets that are from the food company located, exposed to that risk, and assets from the mining companies located at that risk. And so if that water body is under fundamental stress, the idea that you bring both these companies together, you're not actually diversifying the risk. In fact, you're compounding the risk because you're having this double down exposure to very specific areas of high water risk, high environmental risk. And so as we begin to roll this analysis out, it's already giving us a much more textured understanding of fundamental underlying risk in portfolios that I think will probably change the framework in which risk diversification is understood in the future.
Thank you, Alex. I think we have a nice overview now, and I'll let the floor to Kim Mantel for the Q&A. Thank you.
Yes, thank you, Lenny. Thank you very much to our three panelists. So now we'll be moving on to our Q&A session. I invite the members of the audience to please post your questions in the chat. I've seen that we've already received a few questions. So we'll take them in a little bit. Starting with the first question. So what is the risk of window dressing when we're using all these different data sources? I don't know if one of our
I can take that one if you want, because well, window dressing is subject with data we're used to the backtesting risk, which is another version of window dressing, which is using past data to actually produce a strategy or way of investing that looks like it's good, whereas it's, well, actually not that good. What I really think is that you need to know where your data come from and what you're using them for. And by the way, depending on the usage you have of those data, well, you might consider some aspects to be more or less of a problem. As Grégoire was saying, for instance, if you want to build a quant strategy, not having an history is a problem. But then if you're not looking at, the risk and the return of the impact of your ESG approach to your existing strategies, then it can be less of a problem. So it's a question of usage, I would say.
Alex and Grégoire, I don't know if you would like to add something to that?
No, I totally agree that the usage is very important, and the history question is very interesting because even if sometimes you have historical data sets, for example, 10 years of ESG data points, it's important to understand that the thematics used by data providers across times are not the same. And so there is a very interesting study that was made. I don't remember the academics that have done it, but they looked at all the thematics that were used by data providers 10 years ago and all the thematics that are used by data providers today. And it's interesting to see that they are not the same. So biodiversity, for example, is a thematics that is very new and that is used in the scoring since 2015, maybe. But not before. And so if you run a quant strategy, and probably Etienne knows that better than me, it's very difficult because you already know that your score will not be consistent across time. And then when you use it for a backtest, you might get some awkward results, and it will be challenging to understand them.
Yeah, just to complement on that, that's why you need to be very humble with data, mostly in ESG, because they change, because they might blow up, they might sometimes disappear. Another example of what Grégoire was highlighting is the change there was, because I think there were questions relating to that, on the S. For instance, there were a lot of companies that had non-binding policies that look like they were very nice and that were important for them because they were brands, typically brands of clothes. But then at some point, reality came back in when there were typically scandals in Pakistan with factories where actually those clothes were being produced. And the dark side behind the official announcement procedures and communications were actually very different. So the assessment of those social issues took a very different look when you were going beyond the existence of a procedure of anything that was declarative to the actual facts of how those clothes were being produced. So that can highlight through a scandal. And by the way, to make the link with another question about the link to alpha. Of course, it's a big question that comes up in many ways. That really depends on which data you're speaking of. But what has proven to be the most efficient until now in getting alpha from ESG was actually being able to predict which were the growing subjects, which were the future scandals. And in that respect, it still is a very young field where it still evolves according to the most recent scandal we've had that changes the perception and that therefore changes the investments and also the rates that the different companies will get. So it mostly proves that it still is evolving quite a lot and pretty quickly compared to the investment horizons.
So I think let's definitely get back to that question on the societal, the S on ESG, Etienne. So the question from Natalie Kulumeni was which are the main approaches and are there any cultural differences and which are they?
Well, yes, it also comes back to the usage because, well, at first, one of the first approach to S was counting whatever you could count. So, for instance, on diversity was counting the number of women on the board, which is nice, but which might not be very significant of the actual issues of a given company. And as I was saying just before with my example, the true issues with the S are often very much down further in terms of production on how local workers are being treated or external partners. And what we see as an evolution that relates also to the subject of evolution is more and more the externalities, because as the awareness about pollution, climate risk builds up, we see that it goes with social aspects. If some resource is being privatized, then it's actually a very big trouble to society. And well, by the way, in France, we've had the yellow jerseys, so we are quite aware of the dangers of only pushing environmental ideas that can be unacceptable by some parts of society. So in that respect, probably the social part of ESG, so the ESG is the toughest, I find, because it's the one that is the least easy to actually measure, to have true measures on. Well, you can get lots of data on employee satisfaction, on many other aspects, but that's where their link to the actual subjects is the most difficult to establish. At least on governance or on environment, well, you do have clearer measures.
So I think we also mentioned earlier the black box that we faced with today. I know, Gregoire, you mentioned it. So in your opinion, is technology actually helping with the transparency, or is it making it more obscure? I know you spoke about building internal models or putting in place a certain internal governance?
I think if you run a model, either as the asset manager or the data providers, with dozens of thematics included, with different weights and rescaling factors and stuff like that, and you don't explain it to the end investor, then definitively it will not bring any transparency. And if we look from the end investor perspective, so I mean, you and me, when we buy an investment product or when we choose an insurance, for example, we need very simple data to understand what is done from a sustainability perspective. And today, we probably don't have it. So on my side, I'm speaking for my side, I've not chosen my car insurance by looking at the sustainability investment preferences of insurance companies, because even if you have the Article 173 in France that is supposed to help you understanding what is their climate strategy, it's a challenge for you. Try to read it, try to understand who has the best climate strategy, and come back to me and tell me picked up CNP Assurance or Maïf instead of another because they had the best climate strategy. So there's still a huge step, but we are in the right field. And what I like is when asset managers are trying to explain what they are doing, and they are trying to report metrics that can be considered as an impact metric when they will disclose carbon footprint or metrics regarding employment or things like that, that the end investor can understand, and that will help him to better invest.
Thank you, Grégoire. So we're moving on to a question, related question in the chat from Far Bukra. So what are the actions that regulators, investors and companies should take to improve the quality of the data related to ESG? Do you think the regulation is the best response to standardized practices and disclosures across countries?
Oh, look, I mean, this isn't an area that I have a strong point of view, but just so that I can try to say something. So just picking this question up about the relationship between ESG data, for example, and share, just to connect these 2 points between ESG data and share price performance. I suppose I'm still in the skeptical camp that we can say very much in terms of forward price signaling there. But there's 2 things that there's new levels of data can help with. I think there's whatever it can do for investment performance, but it's whatever it can do for the businesses that investors run, right? So the extent to which they can explain to their end investors that they're engaging with companies and company management, and if data is prompting investors to ask the question of those management, that is a form of governance that I think is quite important. My sense is that will lead the process more than regulation will lead the process. I think that capital is nimble and thinks about things in quite short, the time it takes for that process to be executed is quite short. I think the regulatory environment will naturally evolve. I was on a call the other day and somebody was making this point that actually you don't want regulations to get too preemptive and too prescriptive too quickly. I mean, I think again, as the others have said, this is an evolving field. So biodiversity is new to how we thought about these things. Many things are different now to what they were a few years ago. And I think in the short to medium term, I think a flexible approach to regulation seems to make sense, provided this idea that fund managers do what they're meant to do, right, which is to hold the companies accountable through the fact that they're beneficial owners. I think that's where we'll see the best practices of regulation evolve.
And to
complement
that,
maybe on that, because well, I'm a big believer of behavioral finance, and one of the other field where behavioral studies have been used is for regulation in terms of nudge. And I really think that the way regulators are putting pressure, and the Article 173 in France is one example of that. I mean, obliging people to report on something that, well, they don't even know how to calculate. It's a way of actually putting pressure without saying how to do it. So it's part of a global movement where it puts the pressure, but then it's up to investors to actually do it, probably wrong at first, but then to improve it back into a more consensual measure, and also the fact that, well, there is regulation, there are managers, there are investors, is a way to entice companies to actually report on those data, to publish things. In my opinion, what will mostly help, well, is the technology. Well, we have some examples here, but there are lots of ways of measuring new things, which we didn't even think of measuring before, in newer ways also, which don't depend on the consent of either the companies or the people. And well, all these are actually very interesting, because they bring in new data that are actually independent from the troubles that we have identified in the first generation of data. When it's mandatory but nobody knows how to do it, well, then you get very various results that are actually more or less honest. But it also creates the environment that will make it possible for new companies to, well, to be created on improving on that, then spreading those data, then they will evolve. That's why being able to evolve and to follow granular data is of tremendous importance in those subjects.
Okay, and talking about these alternative data sources, we had a question in the chat from Monica Rebrunu. What are your perspective on the value of these types of data, news, sentiment, controversy data from providers for ESG investment and for risk management?
Who wants to take that? So otherwise, I'll start before Alex, because well, honestly, I love those data. I love those data because they are very frequent. They are news. They show other things. But it's true what they show is not really ESG. It's rather a perception of ESG, which, by the way, is a lot more linked to scandals, to public opinion, and it might be actually wrong from the point of view of the actual actions of the companies. It's just a perception, but the perception about companies is a form of information. In my opinion, it's an information that relates more to momentum than it actually does to ESG. But it does have alpha, obviously, just like momentum does.
That's what I was saying. I think that these sentiment analysis data sets are definitively good from a materiality perspective. It helps, I agree, bringing more alpha. From an impact perspective, so bringing some positive action to the society with your investments, then it will not help you. And that's where you need precise data sets. You need to read company reports. You need objective data sets with NGOs, with satellites, with quantitative data points to assess whether the company strategies regarding sustainability thematics is good or not. And so I think sentiment data sets are definitively one of the future, but maybe more for a materiality perspective.
And in terms of technology, so once we have these unstructured data sets, so how mature are the technologies today to actually exploit these types of data sets. Alex gave the example that he uses satellite imagery. So where are we from a technology point of view?
You're on mute, Alex.
So thank you. So in my view, the technologies are pretty advanced. I think the fund management industry is generally using technologies that are at least one generation behind where the state of the art is in science. At least, I work with colleagues in the university here doing certain things on predictive modeling, and it's, they use different stuff. I think the issue is much less that technologies aren't sufficiently advanced. I don't think enough has been done to apply existing technologies to solve the problems or to solve the challenge that investors need solving, right? Which is synthesize the data in a meaningful way to give me decision-ready actions. So I will do some demos where the person wants to know what's going on under the hood, and they want to understand the Python code, and they want to work with the underlying APIs. And I will do others where the person just says, look, I just need to know when I go into a meeting, what are the questions I need to ask that guy? And that's the interesting thing, that this is the end customer, or the fund management customer, is quite a broad spectrum. So it's not so much the technology, I think, that isn't capable or hasn't advanced. I think the use cases and the conversion of that capacity into decision-ready formats is where the challenge is, and that's actually more a challenge of imagination than a challenge of technology. It's not that we can't do this stuff; it's can we articulate what we want to do, and can it matter enough, right? Can it be important enough to the decision maker? Water risk is only relevant in a small subset of companies, right? You don't need to understand water risk in the Great Lakes of Canada. It's a non-relevant ESG indicator. And so being able to synthesize what is salient, what is material, what is relevant, what is comparable, and make that into decision-ready insight, that's the challenge and the opportunity. But I think we have the technological capacity to do that. It is more this question of imagination.
Yeah, I totally agree that technology is mature today, but that the ESG application of this technology is definitively not mature. At Within, we've tried, for example, the NLP technology, so natural language processing, to read company reports. We wanted to extract specific data points from PDF, which is something that is already done on other areas, and well done. We found out Google and Amazon data sets ready to use and pre-trained, etc. But the difficulty when you use this technology is to adapt them to your specific context. And the ESG context is not that easy, because if you look at carbon footprint, for example, in company reports, it's really hard to gather, because you have the scope 1, scope 2, scope 3. Sometimes company will report badly the scope 3, so you need to understand all the context around the data, and not only extract the data point itself. So it's not that easy to use, but I definitely think that in the coming years it will happen, and the companies that have invested in these technologies will have a key advantage.
Thank you. Unfortunately, we're running out of time, so thank you very much. I think I'm going to pass the mic on to Gabriel for a quick conclusion. Thanks, Gabriel.
Thank you, Kim. It's time for me to conclude this exciting debate. Thanks a lot, all of you. Thanks, Etienne, Alex, and Grégoire, for their participation in this event and having been able to decipher the challenges of tomorrow, today and tomorrow, that represent the ESG data. A huge thanks to Kim and Lenny, who organized and animated this debate. Thanks to Marie-Alix, without whom the technical realization could not have taken place. I hope you have enjoyed this event. We are waiting for you for the second episode of this ESG and tech series that will deal with models and ratings. So see you on 26th of January with the 3 other panelists. And finally, don't miss our second event of the climate series, which will take place on the 9th of December, where we will deal with climate risk as seen by asset owners as well as green bonds. Thank you to all of you for attending this event, and see you soon. Bye.
Thank you.